Hello and welcome to this Tuesday's morning market briefing. We've got lots to talk about, but firstly, Ford chair warns extended strike will boost Tesla, Toyota and China stocks, as well as that Italy unveils 24 billion euro tax cut policy, and this is kind of in a bid to stimulate economic growth, during times of global economic struggle that we are seeing. We've got lots to talk about on the charts also, and lots is happening on the economic calendar, which we'll come to near the end, so make sure you stay around to see that, but make sure to subscribe as we get straight into it. So first to talk about, of course, is the Ford chair, which has warned of this extended strike having damages to the wider economy. So the executive chair of the Ford company called for an end to a strike by US car workers as it enters its second month, saying that the drawn-out walkouts will help Tesla, Toyota and Chinese car makers and devastate local communities across the US. Now this comes as Bill Ford spoke on Monday as members of the United Auto Workers Union continue to strike at plants owned by his company and by General Motors and Stellantis. And so this is kind of a topic that we've spoken about once before, not too long ago, maybe 2 weeks ago, but really about kind of the United kind of Auto Workers Union really making a stand against Ford and against these larger car production companies. As we know, many individuals are currently battling with the cost of living crisis, higher levels of inflation, and with that many people are demanding higher wages as a result of it. And this is kind of what we've seen across many nations, across many industries, but the US kind of auto production industry, has received some very, detrimental impacts from this, kind of wide scale striking kind of move by workers. And Ford, with the UAW, so the United Auto Workers Union, last week targeting Ford's most profitable factory. And Ford said in a live stream speech on Monday, non-unionized car makers such as Toyota, Honda, Tesla and the others are loving this strike because they know that the longer it goes on, the better it is for them. They will win and all of us will lose. So this is kind of Ford, trying to pivot their message around the strikes to really being one of, you're only damaging, the country which you live in by continuing to strike, by striking these ununionized kind of workers are, helping a growing, well, not necessarily the workers, but I mean, the businesses such as Toyota, such as Tesla, and many Chinese car companies will only see growth out of this. If people aren't able to get their car through Ford, it's quite likely that they might go to Toyota or Tesla for that same sort of, price, same sort of kind of make, and therefore it's only damaging Ford as well as the rest of the US nation, which Ford obviously represents as the US. Now saying, he also did say that also a longer strike will have a major impact on the American economy and devastate local communities. So trying to really focus this on an American issue whereby, prolonging the strike is really only hurting America. Now, the UAW began to picket selected Ford, GM and Stellantis locations on September 15th as they seek better pay and working conditions. And this is what we spoke about a little time ago, is this kind of beginning of the auto workers in the US really taking a stand for this better kind of pay and working conditions dispute. Now, by targeting new factories, union leaders have disrupted operations whilst conserving the fund they set up to pay workers on the picket line. So really kind of interesting strategy for their their union strikes, really trying to focus on the most expensive, highest reward kind of picket lines by focusing on these highly efficient, newer factory production sites, such as, you know, a lot of the green energy focused ones, so such as, you know, the electric car factories, and they're mainly focusing their efforts there to disrupt Ford the best they can. Now, Ford is investing billions of dollars to supply a growing lineup of electric vehicles in a bid to gain a stronghold in the new and growing electric vehicle industry, including the creation of 3 planned EV battery plants. And this is really what the auto workers are trying to target, because they know that this is a key push by Ford for a new level of investment. It's a very important factory for them, and so by picketing specifically there, they're most likely going to have the highest rate of disruption. Now, this deal will also include, this will include a deal with the Korean battery manufacturer SK Innovation, and the union, however, is holding this deal hostage because of the plants, which are pivotal for the future of car manufacturing. So they're really focusing their efforts around these newer, more important factories surrounding the kind of electric vehicle craze that we're seeing as we focus on more sustainable kind of cars and that sort of thing. And over the weekend, Ford said it furloughed an additional 550 workers across 6 plants, so different parts being manufactured in these different plants. As a consequence of the strike, it had sent home 2,500 since the strike began last month. So 550 workers were sent home as a consequence of the strike, and it sent home 2,500 since the strike began last month. So significant numbers of people that they're sending home as a result of these strikes. So it's really going to be interesting to see how this works out for Ford as it tries to enter this competitive market. And Ford did say this should not be Ford versus the UAW. Bill Ford said instead it should be Ford and the UAW versus Toyota and Honda, Tesla, and all the Chinese companies that want to enter our home market. So he's trying to make the pitch here that we're on the same side here. We're fighting for America. You're unionized. Yet if you were any of these other car manufacturing companies, you wouldn't be able to be unionized. So this really is a together struggle, and stop fighting us basically when you've probably got bigger enemies on the list. But that's all for that article. Make sure to keep your eyes on the issues around Ford and the United Auto Workers Union, which are striking a lot at the moment. So next to talk about, of course, is Italy, which unveils 24 billion in tax cuts and pay rise to spur flattering growth. Now, Italian Prime Minister Giorgia Meloni plans to spend 24 billion on tax cuts and public sector pay rises next year to spur consumption and support faltering growth. So it's kind of an interesting position to be making at the current economic conditions, and kind of mirrors more of what we saw last year with Liz Truss's economic policy, where she kind of focused on supply side issues whilst trying to bring down taxes to stimulate growth. But of course we know how that did end politically wise, not necessarily whether the economic decisions actually went wrong, but she was politically ousted as a result of kind of introducing these kind of more revolutionary market focused ideas. Now, this comes despite investors' concerns over the country's finances, and her cabinet approved next year's budget on Monday, so yesterday, with Meloni saying our first priority is to defend the purchasing power of families, with her finance minister saying that the budget is solid, adding that he's confident that once the details are read, it will have a positive approval in Europe and by the markets. And this is really the rhetoric which we've been hearing repeatedly from Giorgia Meloni and her cabinet, especially around supporting the Italian people during this time of economic crisis, and really almost engaging in conflicts with the European Central Bank over their interest in raising rates further, which Giorgia Meloni opposes as a result of kind of seeing how it's damaging the ability for homeowners to finance their houses, or younger individuals to purchase new houses. And this is kind of her struggle within Europe to fight Brussels on this issue, and to fight for the EU to essentially have lower interest rates through the ECB, as she's kind of seeing this as a large issue which is causing the pain for the Italians' pockets to kind of diminish, less money for the Italian people if more of it is being spent on financing their houses. Now, Italy announced last month that it was raising its fiscal deficit target for next year to 4.3% of gross domestic product, and this is up from 3.7% in April. So I remember when we spoke about this, probably last week it was, but we definitely highlighted how Giorgia Meloni and her government were kind of changing the way that they saw managing their fiscal deficit, and almost looking to raise it in the short term to try and stimulate the economic growth that would pay it back in the long term. So it'd be interesting to see how that plays out. Obviously, it's a very risky move, and one that's been tried before by Liz Truss, but not enough people, I guess, had confidence in that to see it through, and therefore was politically ousted. So it'll be interesting to see whether we see that same kind of result for Giorgia Meloni, although we kind of doubt that. Now, to put it into context, the significance of this change in fiscal deficit level, its fiscal deficit would not reach the EU mandated fiscal deficit limit of below 3% of GDP until 2026. So it'll be really interesting to see how, as a result of this kind of difference in ideals for the fiscal deficit of Italy, whether this will continue to create more tensions between Italy and the EU. As we already know, it has been quite strained relations, so it'd be especially interesting to see how this might play out within the EU. Now, this announcement saw Italy's benchmark 10-year bond yield soar above 5% for the first time since Europe's sovereign debt crisis 11 years ago. And obviously, with yields going up, this means prices are falling, and if prices are falling, that's often as a result of a lack of demand for those bonds. So obviously, as a result of increasing this fiscal debt limit and projections, obviously this is showing that more and more people are becoming less confident in Italy's government to pay back these bonds, therefore reducing their demand of these bonds, and therefore causing the price to fall and yields to rise, which is obviously what we've seen here, and some rising to some significant levels, as they've noted here, with it reaching for the first time the levels seen in Europe's sovereign debt crisis 11 years ago. So really high levels in comparison to the past. So it'd be interesting to see how Italian bond markets might play out as a result of that, with the gap between Italy's borrowing costs and those of Germany rising from 171 BP a month ago to nearly 200 BP. So significant differences now in the borrowing costs between Italy and Germany, as obviously Germany's maintained more of a kind of fiscal deficit a focus on not increasing their fiscal deficit too much, whereas Italy's more so focused on building that growth through possibly increasing the fiscal deficit in the short term. And Meloni criticised the ECB, as I said earlier, for high interest rates once again, saying the recent rate rises will cost Italy an additional 13 billion euros in additional interest payments. And we can't doubt as well, the increased bond prices, the increased bond yields as well. On top of that, as a result of this announcement, will only further hurt, Italy in terms of their annual interest payments, which they do have to pay. The rise in fiscal deficit also does come from Italy's spending, and their spending is coming. Sorry, I'll repeat that. The rise in fiscal deficit comes from Italy spending 4.3 billion euros to cut income taxes for low and middle income workers, as well as 7 billion euros for public sector salary increases, with a lot of that going towards the public health sector, with their pay rises going up, and 1 billion euros on new initiatives to encourage Italian women to have more babies. And this is kind of an interesting point, really, because it really comes back down to Giorgia Meloni's kind of push and rise to power with her more traditionalist focused policies, and her focus on, you know, supporting the Italian people first, kind of being a resounding message, which did enable her to come to power. So it's interesting to see how she's really now focusing on, you know, those low and middle income workers, making sure they have enough money for what they need, you know, providing public sector with a great deal of pay, but at the same time focusing on the more traditional side of, you know, enabling and, you know, encouraging more babies for Italian women, which is more traditional, of course. Now, to help finance these measures, Giorgetti said the government would cut around 5.5 billion euros in spending from various government ministries and local administrations. So it'll be interesting to see where they can really source that, you know, cuts in spending, and whether they can actually end up financing what they want to finance. Now, Meloni's government forecast that Italian GDP growth would be 1.2% next year, and that compares with the IMF estimate of 0.7%. So clearly there's, you know, a disparity between what, you know, the Italian government predicts for themselves and what the IMF actually predicts. So it'd be interesting to see what the actual result ends up being. But that's all for the articles, really. Next to talk about, of course, is the charts, where we haven't seen too much in terms of US indices. However, we have seen that rise come out of yesterday's session, breaking above this prior high and kind of breaking above this, you know, significant area of liquidity and resistance that we had highlighted. Obviously, there was an area of liquidity, you know, first formed earlier on the 29th of September. And that held through as strong resistance going into the 10th of October and all of last week and going into this week. However, with, you know, the strength coming out of yesterday's markets, we were able to break above it on the US 30, you know, breaking above that prior high. So it will be interesting to see how far it can really go now, possibly even retesting this area of liquidity before moving higher. And this is kind of what we've seen only on the Dow Jones, with, you know, the US 100, so the Nasdaq, obviously presenting different price action, where it hasn't been able to break above its prior high made on the 12th of October, and more so is presenting a bit of a bearish image, where we've kind of seen this decline, and now we may be even seeing a retracement to the upside as, you know, the US 100 begins to reverse. So definitely keep your eyes on US indices as they shape up to be in an interesting position. But next to talk about is the dollar, which of course we come back to all the time. But yesterday I did note, you know, that we were kind of seeing this head and shoulders almost form on the dollar, and so it'll be interesting to see how, you know, fundamental news might impact that. And today we've kind of seen, you know, further representations that possibly we are forming what is a head and shoulders pattern, with, you know, this being the first, you know, a left shoulder, this being, you know, the head, and now we've kind of formed this right shoulder, with this baseline being formed at this area of liquidity that we noted. And then with the US inflation data coming out last week, we did see that bullish rise, and, you know, coming into the start of this week, we have seen that sell-off and that retracement. But of course, we need to be looking out for what fundamental data is really presented, because of course, whilst it is presenting a head and shoulders pattern and it has come into contact as, you know, a kind of resistance line for this trend line which once existed, it will be interesting to see whether in fact it can still find a way to push higher in line with any fundamental news or, you know, data, as it is nearing that 50% Fibonacci mark, and, you know, also nearing that 61.8% Fibonacci area, which we've marked out with a strong area of liquidity sitting in there as well. So definitely keep your eyes on that. The next to talk about, of course, is pound yen. which has seen a rise going into today, kind of bouncing off that 38.2% Fibonacci area. And, we were wondering what sort of, kind of trend are we going to form on pound yen. Of course, we have created this bottom almost following this bearish short-term trend. And overall, we had been existing in a longer bullish term trend, I guess you could see. But since forming this bottom of the market, we have been struggling to break above this prior trend line, which did work as a, an area of support for the bullish movements on pound yen. However, has ended up being used as a kind of area of resistance. So it'll be interesting to see whether, pound yen can break above this level or break higher, because obviously, although it's come into the 38.2% Fibonacci area and it has that bullish reaction from it, it hasn't had too serious of, a movement to the upside yet to really say, this is now on a bullish trajectory. So definitely keep your eyes on pound yen as we kind of look to see how it might shape up its performance. Now, next to talk about is USD JPY, where not much is really happening, but we continue to have a look at this 38.2% Fibonacci area. Obviously, it broke out this bullish flag, moved up, failed to break above this area of liquidity, sold off from that point. So it'll be interesting to see whether now it will make its way down to this 38.2% Fibonacci area around the 149.2 area, and whether it will use that area as liquidity to move further to the upside. So definitely keep your eyes on that going into today's trading day. But next to talk about, of course, is Bitcoin, which has seen some high volatility movements yesterday as it peaked, pushing to near 30,000 bitcoins per dollar, $30,000 per Bitcoin yesterday, really nearing that territory. However, it has, sold off from that area. And this has come as BlackRock has announced that the SEC has, kind of rejected its Bitcoin ETF kind of approval. And this is something that we highlighted maybe 5 weeks ago, is this kind of push by many asset management companies for their ability to establish a Bitcoin ETF, which would enable Bitcoin to be traded more freely and kind of properly without too much manipulation. However, the SEC has come back to kind of arguments around manipulation often to say why it shouldn't be able to have its own ETF. And this is what we've kind of seen here, is the SEC rejecting that request, and as a result we've seen that sell off as people expected it to come in as an accept kind of response. However, we have not seen that, so definitely keep your eyes on Bitcoin as we look for more decisions on Bitcoin ETFs and whether they get approved or not. So next to talk about, of course, is gold, which has recently pushed from this 1814 area and pushed as a result of the continuing escalations in the Gaza-Israel conflict. And that's what we really saw, and allowing it to push to that 1930 point on the charts, and we've seemingly not been able to break above that. Yesterday, retracing down to the 38.2% Fibonacci area, where we did note some area of liquidity earlier on, but it did not perfectly line up, so that's certainly something to note. Now it has responded positively from that 38.2% Fibonacci level, but not positively enough for us to immediately say now it's going to continue on a bullish trajectory. Obviously, this was a really significant move to the upside, and as a result on the RSI, which I'll bring up here, it did move into that overbought territory, and from that area we did see a sell-off. So it'll be interesting to see how Bitcoin does shape up as escalations in Gaza and Israel mount, and whether this ground invasion does take place, because obviously if it does, that surely will send gold higher. That said, it's likely that ground invasion has been priced in already, so the reaction may be less than expected. So definitely keep your eyes on Bitcoin as we experience a high level of volatility as a result of geopolitical events. But lastly, to talk about on the charts, of course, is Brent crude oil, which once again comes back to the same conflict of Israel and Gaza. However, we did note yesterday whether oil would be able to break above this area of resistance that we had noted. It seemingly hasn't, coming out of yesterday's market, so we could be possibly looking at a retracement before a move higher, possibly down to this 50% Fibonacci area that we have noted here, which also lines up with that kind of significant area of liquidity. So it would be interesting to see whether it can make its way down there and possibly make a bullish move from that level in line with geopolitical events which may take place. So definitely keep your eyes on gold as events shape up in Gaza and Israel. But that's all to talk about for the charts. Lastly, to talk about, of course, is the economic calendar, where we have a great deal of significant data coming out today. So some really important data coming out today. And firstly, we have RBA meeting minutes. So obviously any information around Australian kind of monetary policy is obviously very, very important if you're trading any AU pairs. So as that, we have the UK's unemployment data. Obviously this plays into the government's policies as well as monetary policy. So definitely listen out for that to see how that might be affecting the UK's monetary policy. As well as that, we've got Eurozone and German economic sentiment data. Obviously we know that's quite poor at the moment as a result of weak production levels within Germany, especially around manufacturing, and of course the high interest rates which have been damaging lots of sectors of the industries in a bid to reduce inflation. So definitely listen out for that. As well as that, we've got Canadian inflation rate, US retail sales, US industrial production, because as we know the US has been one of the kind of key stars and bright spots within the global economy, as the whole world has been kind of consumed by this global economic issue, and so definitely look out for US industrial production, as the kind of belief at the moment is that the US industrial kind of sphere and US economy as a whole is one of the bright spots of the world economy. As well as that, we have numerous Fed official speeches, so obviously that plays into US monetary policy, and finally the US monthly budget statement. So lots to talk about, and lots of data coming out today. We've covered a lot on the articles as well as lots on the charts as well. So I think we've got a lot covered. I hope you have a great trading day. But that's all from us at Wildwood Capital. Have a great one. See you later. Bye.